discussed about higher time frame analysis. We talked about why it's important to analyze higher time frames, and when we talked about analyzing higher time frames, we did mention three things that you should focus on when doing that: old highs, check if the market is trending or if the market is consolidating. We did analyze each boom and crash instrument and how it's been performing since its inception, right? So welcome back to Boom and Crash Capitalizer. This is the final episode, and we will be looking at lower time frame analysis, right? So before we start, there is something here you need to understand, that being able to execute a trade and not worry if it plays out or not is a big flex. But for you to be able to not worry about a trade, you have to be confident enough. You gotta have something that you can rely on. You have to have a strong foundation. You gotta be knowledgeable enough to know why you did take on the trade. Sometimes we worry about a trade because we are not certain, if we are not sure or we do not know what exactly is, what are we trading, or why do we trade what we trade, right? So you should be in a position that you know your thing, and that's why we are here today. That's why we are introducing the strategy to you, so that you have an edge in the marketplace, right? So let's continue with the lesson. So what exactly are we talking about when we talk about lower time frame analysis? So lower time frame analysis is the use of 1 hour, 30 minutes, 15 minutes, and 5 minutes to look for entries and exits. So using lower time frames allows you to find many trading opportunities, and the movement of price action in lower time frames are fast. So with that said, when you couple higher time frame analysis with lower time frame analysis, this will turn you into a better trader, or it'll make you a better trader, right? And you will become a better person yourself, right? So you are able to convert more money in smaller time frames in a shorter period of time. So these are the time frames that we will be focusing on when we look at this, when we go through this lesson. So this is what we will be looking at. We'll be looking at the trading range. We'll be identifying liquidity from internal up to external range liquidity. And then we will be looking at live charts. And from our previous two lessons, we will be utilizing what we learned from those lessons. If you have not seen the lesson or watched the lesson, you should check it out on YouTube. The links are there. We have shared the links with you on Telegram, or you just search Capital Tradings on YouTube. You will find the playlist there, right? So we are going to look for entries and exits utilizing price action and higher time frame analysis. And then lastly, we have a major announcement from us, Capital Trading, to you, right? So stick around to find out what that could be. Now let's start. When we talk about a trading range, what exactly do we mean? A trading range occurs when a security trades between consistent high and low prices for a period of time, right? So there are 3 points of interest in a trading range. We have the premium, the equilibrium, and the discount. We are going to look at those in the next slide. So when we talk about a trading range and coupling it with its points of interest, we are going to, this is our quote, or this is what we'll be saying every time before we look for trades. When we identify a trading range, we are going to sell at a premium and we are going to buy at a discount. So this is something that you should consider at all times. You shouldn't find yourself buying at a premium when price is expensive and selling at a discount when price is cheap. So, or when it's expensive for that direction, right? So what exactly do we mean when we talk about selling premium and buying discount and equilibrium? So remember, the definition of trading range is that this occurs when a security trades between consistent high and low, right? So now let's identify our high and low in this case. So if you look at this on the right, we have a chart from a specific or certain boom and crash instrument, right? So we identify a swing high. A swing high basically is just a high that's hard not to miss, or that's higher than higher than the highs that are next to it, and then the lowest low that's lower than the lows next to it, right? For that identified range. So when you look at a range, there is a premium and then there is a discount, and then the midpoint between that range, that's the equilibrium. This is what we mean. So for this case, this is a setup that we are going to identify our range when we are looking for a sell. So when we look for sells going down, what we do is we are going to look at a high before we look for a low, because we want the retracement to the upside, then we go short, right? So we look for the high first, we identify a high, and then we identify a low. So then we look for sells when price is above equilibrium. So when price is above equilibrium in the range, we consider that cheap to sell, right? Because it allows us to frame a better risk, or it reduces our risk when we are entering a trade. So let's look at another example. This is another example from the same chart. Remember, we had picked this high and this low, but this time around, let's say our range ranges from this high and this low, and we are looking for sells. We are going to look for sells when price is above equilibrium to take it down, right? Then what does looking for buys look like? So if we are looking for buys, we identify a low first and then a high next, right? So this is our distinguished low, and then we identified our distinguished high. So this is the equilibrium of the range. So immediately price dips down below the equilibrium and gets into a discount, we look for buys to go long. In this scenario. So let's consider a different example. So we have identified this significant low or swing low, and then we identified this swing high right here. Two highs, right? And they are equal. So what we do is we want price to go up, and then when price comes back down, we look for longs because price is cheaper below the equilibrium, right? So that's what we do. Now I hope that was clear. You can put a comment on the chat if you need clarification. So now let's jump into liquidity. Liquidity, this is a term that any other trader out there is always using, but for the most case we always wonder what exactly is liquidity. So this is how we define liquidity here in capital trading. Liquidity pertains to an index's ability to be bought and sold without causing a significant change in its exchange rate. And liquidity, in short, refers to how active a market is. So, in short, or just a more simplified mode of putting it, liquidity is linked with the trading range. One cannot go without the other. You need to identify a trading range to find liquidity, and you need to identify liquidity to find a trading range, right? They are interlinked. And liquidity identification is important when looking for trades. Note that there are two types of liquidity, right? We have internal range liquidity. These are points of interest for the market within, note this term here, within a range, right? And then we have external range liquidity. These are points of interest for the market outside an identified range, right? And we are going to utilize old highs and old lows, trending and consolidating markets, price action tools as our points of liquidity. You might be wondering, what are those? What are those? Well, they were explained clearly from our two previous sessions. So go watch our two previous videos on YouTube to find out what these are. And now you can find both internal range liquidity and external range liquidity in the same trade setup or in the same analysis. So now let's get our hands dirty and get technical. I'm going to open up a chart. So what you're going to do now is, first things first, we identify our range and then look for internal range liquidity and external range liquidity. So from the chart on the screen, we have identified a range. So remember, if we look for a high first and then a low later, this means that we are looking to go what? Short, or we are looking for sales in that specific trading instrument. And in this case, this is a crash 500 instrument, right? So we have our range high, which is the premium zone or the premium level. We have our equilibrium and our range low, which is the discount. So take your time, utilize what we learned from lesson 2, price action tools, right? I am going to jump into the next chart to help you with that. What do you see when you look at the chart? From these zones or from these points that are being highlighted, can you recall all the trading tools that we learned from the previous 2 sessions? Because I don't know about you, and it's important that you understand, or you are able to identify these tools so that all of these lessons are not in vain, and it shows that you have been studying on your side. So now what I'm going to do is I'm going to show a chart with that's with the lipstick of all these things that we had identified or we learned from our two previous lessons. Yeah. So it's kind of messy right now, right? But the more you study these things, the more you realize that the mess is worth it. So we have our range high here and then our range low here. So what does this mean? This means that let's imagine the current market condition was here. Ignore the rest of this movement. Let's imagine the market was here. So if the market was here, you need to find reasons why the market should go up back to here, to somewhere, to back above the equilibrium, so that we look for sells, right? So what happens now is our eyes turn back to previous price action or previous market movement. And when I look to my left, I see an old high, I see another old high here, I see a fair value gap, I see another fair value gap, and I see this here. This looks like an order block, right? So I'm trying to give myself reasons why price should go to the upside so that I sell price when it's cheaper. Remember, in capital trading, we don't chase price, we chase money. So that means we anticipate price to come to a specific or certain level so that we sell when it's cheaper. Because imagine if you were not knowledgeable about a trading range and you just took a sell. Let's say this was your order block, right? If this was your order block and you decided that I'm going to sell this because I've watched lesson 2 from capital trading and they have taught us about order blocks, so whenever I see one I'm going to go short there. So you come here, the market, you go short, you put your stop loss here, they take out your stop loss and you're like, nah, okay, let's try this again. You wait for them to come to this a block here and then you take another sell and they take you up and then you're like, what capital trading is a scam, they don't know what they're talking about. But yo, you did not find your trading range, so you need to know your trading range so that you don't just take sells, you don't just take any trade. So what we do is we are like snipers on the rooftop, right? We wait, we anticipate, and then we wait for that one shot, one headshot, and then we kill. We are not a machine gun here. We don't just shoot. We anticipate, yo. So back to business. So what happens now is after identifying this previous tools that we learned about, now we would want price to come here and then price starts unfolding, now what we'll do is when immediately price goes above equilibrium, that's when we start loading our bullets, that's when we start holding our trigger and wait for shots. But for you to wait for shots, your target needs to be in range. And how do we identify range? We have an old high here. We would want them to take this old high out, and then we would want them to come to this fair value gap. They'll either, remember we studied the anatomy of the fair value gap, they either have to touch the low of the fair value gap or the high of the fair value gap, right? Or the midpoint. So any sell on either of those levels is still ideal as long as your stop loss or your risk is above or away from those two levels, right? So if we take a shot here, or before we start taking shots, we would want them to react to these levels. So they did give us a positive feedback, they reacted. Now let's look at our next level besides the fair value gap. They still went up. So where do our eyes go to? We see a fair value gap here, and then from the fair value gap, we extend to the right, and then price reacted to the fair value gap low and dropped heavily, right? So these are this is one way, there's a good way of utilizing our price action tools. So it's either you look for an entry here, or you'd want them to drop and then go to the upside, and the same setup up of the fair value gap low, you still look for the same sell scenario here and go short. So this is how we'll trade Crash 500. Now let's look at a different chart. So look at this chart, right? Disregard everything in the gray box and identify a trading range, and identify internal range liquidity and external range liquidity. So I think we made a mistake because from our previous two charts, we did not identify where exactly our internal range liquidity and our external range liquidity is. So I'm just going to pull up this chart again. So our internal range liquidity, remember from the definition, these are points of interest for the market within the range. So that means that we are going to look for our price action tools within this range, between the range high and the range low. And that's what we did earlier when we identified the old highs, old lows, fair value gap, order blocks. Those are our internal range liquidity. And then when we talk about external range liquidity, they took out this old low. When they reacted to this fair value gap low, right, they went straight down and they took out this low, and this low is our range low. So that means they took out our old low, and this becomes an external range liquidity, right? So that's how you identify one. Now, an assignment to you, I want you to look at this next chart and identify internal range liquidity and external range liquidity. Okay, so from the chart, I'm seeing a range high and the range low, but remember we identified the range low first, then the range high. So that means that we are looking for the market to retrace to the downside, and then we look for longs here. But where exactly do we look for longs, right? Or where do we look for buys? So let me give you an idea. I have highlighted these points of interest. So we have this, this. What could this be? Okay, now let's get technical. So we have this range low here, right? And then we have this range high here. So we would want the market to drop below our equilibrium point, right? And then we look for buys to go long. So let's disregard everything here. Let's imagine the market was here. So when the market is here, we are going to look to the left. We would want them to take out this low, and this probably not take out this low, but as long as they're below the equilibrium. So that means that if they're above the equilibrium, we are automatically triggered and we are certain that they should take out this low. So when they do that, they take out this low here and they went up, they formed a new low here. So that means that we would still want them to take out this low, and they did exactly that. They took out this old low and formed another low. So we can either look for a long here as long as our risk is below the range low, and then hold until for price, or if our analysis tells us that they should go lower than the current market low, then they are going to go low, and then that's when we look for longs to go up. So that means that when they do this current movement, they create a liquidity void here. If you don't know what that is, video 2, episode 2, check it out. And then they go up to fill this liquidity void. We have this fair value gap here. So before they get to the fair value gap, they went up and took out this high, the high of this candle, and validated and turned it into an order block. So they come and retest that order block, and they went to the upside. And when they got to the upside, they reached for a bearish order block that's coupled with a fair value gap, and they dropped. When they dropped, what exactly did that drop into? Yeah, that's right, a mitigation block. So when they dropped into our mitigation block, they went to the upside. What did they do? They took out this old high, and that means that we just got our external range liquidity. So this is systematic, it's algorithmic, and you have to be patient for this to turn out for you, because it takes time for this kind of movement to unfold. But you just have to be patient to see this in your chart. You don't force setups, you just have to see something that you recall, or a repeating pattern. If you know what an order block is, you'd want to, if you're not certain about the setup, let's say you'd want them to go up, and then that's when you come and look for buys. You'd rather wait, and when they do, they take out this swing, this previous high. Usually what they do is they'll take out highs and come back for retracement. Immediately they do that, you enter for a buy. We want them to come back after taking out this old high. We would want them to come back, and then we look for longs. But before we look for longs, what's our next internal range liquidity, or our point of interest? We want to fill up this whole liquidity void that they left here, right? They left a big liquidity void, so we want them to pay up. So we are going to trade that movement. We are going to try to fill up that liquidity void, right? So it doesn't matter whether this is crash 500 or boom 1000 or boom. It's a boom instrument and it's spiking to the upside, or it's a crash something and it's dropping to the downside. The cool thing about price action is that it's the same everywhere. So you can trade crash 500 to the upside, or you can trade crash 500 as drops. So it applies on either side, right? So now, with that said, we are going to come back to this chart, but let's get to the juicy part of the lesson, the one that everybody has been waiting for. How do we look for buys? How do we look for entries? How do we look for exits, right? So before I continue, I have a question for you. Have you watched part 2 and part 3? Drop a comment on the chat. If you have not done that, this is gonna be confusing for you, but it's okay. You can stick around and you can go revisit the lessons later. So how do we look for buy entries and exits? We look for buys when the following conditions are met. 1, we are below the equilibrium in our identified range, or we are in a discount. 2, price has filled the liquidity void prior to the current market price. 3, price returned to a fair value gap. 4, price has reached a bullish order block. 5, price has left a bullish order block and tests a propulsion block. 6, price retests a bullish mitigation block. 7, price retests a breaker block. It's a long list. It doesn't end here. You just have to find a system that works for you. You just have to train your eyes to identify all of these things so that you are able to execute well in time and not miss moves, right? So we also look for buys. It's not in the list, but we also look for buys when price takes out an old low, right? And then where do we look for exits? We look for exits when we are above the equilibrium in our identified range, or we are in a premium. We look for exits when price has filled the liquidity void of the current market price. We look for exits when price returns to a fair value gap, when price has reached a bullish or a bearish order block, when price retests a mitigation block, when price retests a breaker block, which is bearish, and when price takes out an old high, right? That's a lot, I know. You gotta spend a lot of time in your charts and learn these things so that you are able to identify them in an instant. So now let's go back to our chart. Do you remember this chart? This is the Crash 500 on the 15 minutes. Remember, we execute our trades on the 15 minutes and we analyze our higher time frames on the daily, 4 hour and 1 hour. But for this lesson, we are just going to focus on the 15 minutes time frame. So if you can identify your internal range liquidity and you can identify your external range liquidity from your identified range, then it's safe now to say you are ready to look for buy setups. Remember, this is our points of liquidity, right? Now, what we're going to do is we are going to use this. We are going to execute trades on this range here. We are going to look for longs. So I'm going to give examples of how we at Capital Trading would have traded Crash 500 on this day. This chart was harvested on the 25th. I think this is last month, 25th of February up to 26th. Right, so go check it out and study it and annotate it for yourself. But this is how we could have traded it. Trade number 1. When price came to the range low, right? The range low is a bullish order block. We have this candle here. So on this candle, we have studied the 6 points or the 6 points of the anatomy of a bullish order block. We find the high, the high of the candle, the body open of the candle, the body close of the candle, the candle low, and the midpoint of the candle. Those are, oh, that makes 5, right? 5 on the list. So So that makes these are the points that we gotta look at for sensitivity. And let's extend that. This is the close of the body of the candle. Price rejected on the order block, body close. It's not open, but it's body close. And look at the reaction. They went up, they still came back to retest and still continued to the upside. So if we were to execute a trade here, this is our risk. This is where we would put our stop loss and would go long. And if we were to go long, right, we would want an internal range liquidity point to exit from. We do not have to hold for this entire movement. Mind you, you never know if it's gonna go up there, right? Unless, of course, your analysis is telling you so, but we are 100% uncertain in the market. We never know what the market is gonna do next. So if it's like that, we'll rather look for the nearest points of liquidity. So we have this bearish order block here that's coupled with an old fair value gap. So we'll take this trade and close right there. We won't hold for any further moves, right? Trade number 2. It's the same execution, same risk, but different exit. Instead of this, we are going to exit when the price reaches this order block, this bearish order block over here, right? So we enter, we hold, and up until they reach our bearish order block, right? That's trade number 2. Trade number 3, right? So for trade number 3, we enter when price rejected here, right, from the range low. They went up, formed a new high, and came back down. And when price went up to take out this high, this newly formed high, we would want them to come down. And when they come down, we identify our order block here. And when price comes back, we execute our buy right there. Our risk is below this old low, and then our exit is gonna be as soon as they reach this bearish order block that's coupled with the fair value gap. Trade number 4, I'm gonna lose count because there are many trades, so remind me. Trade number 4, when they came back down to the order block, they went up. They reacted to this bearish order block. Then they came back down into a mitigation block. So that means we execute a buy here, and our risk is just below the body close of this down close candle, which is the mitigation block. So we enter here and exit as soon as they reach our bearish order block again. So it's a short-term scalp. Then trade number 5, from the same chart, right? This is a good example of many ways of skinning a cat. So with the same entry from the mitigation block, we hold for the bearish order block. We exit as soon as price reaches the bearish order block here. Trade number, okay, I lost count. Okay, let's try 6. Trade number 6, right? So when they came back, they returned to this order block. I think we looked at this trade. Okay, fine. We execute when they reach this bullish order block, and then we execute when they reach this bearish order block. Then trade number, okay, what's this, 8, 7, somewhere there. So now in this case, we execute from this bullish order block, but we are going to want to trade our external range liquidity. We would want them to take out this high. So as soon as this high gets taken out, we are out of the trade. So this would be another way of trading external range liquidity. But guess what? These trades where you look to take out external range liquidity, they are not ideal, because sometimes that may never be the case. Since this is our identified range, they might come now, and this, when they're above the equilibrium, this means that price now is cheaper for sales, so they might return as soon as they reach this order block and go to the downside. So let me give you an ideal setup that we will take here in capital trading that would allow us to exit the marketplace without having to worry about price turning on us. This right here. We execute when price is below equilibrium, and we exit as soon as price goes above equilibrium. It doesn't matter where exactly, but as soon as we are above equilibrium, we want to exit this trade, right? So that's how we would trade it. So let me identify this. How about this one? Okay, so let's imagine a scenario where we had bought on the range low on the discount, would still exit as soon as they are above our equilibrium point here. So yeah, that would be an ideal trade scenario for us, right? Now, how do we look for sell entries and exits? Let's go through the list. We look for sells, disregard this buys. So we look for sells when the following conditions are met. 1, we are above the equilibrium of in our identified range, or we are in a premium. 2, price has filled the liquidity void prior to the current market price. 3, price returned to a fair value gap. 4, price reached a bearish order block. 5, price left a bearish order block and tests a propulsion block, right? 6, price retests a bearish mitigation block. 7, price retests a bearish breaker block. And where do we look for exits when we are in a sell? We look for exits when we are below the equilibrium in our identified range or in our discount. We look for sells when price has filled the liquidity void of the current market price. We look for sells when price returns to a fair value gap. We look for sells when price reaches a bullish order. We look for exits when price reaches a bullish order block. We look for exits when price retests a bullish mitigation block. We look for exits when price retests a bullish breaker block. We look for exits when price takes out an old low. That's a lot, right? Funny thing is, the list is not complete. I think we needed a different series where we just look for sells entries, and then another series where we just look for buy entries and exits. Okay, we'll put that on our maybe to-do list. So let's look at a chart. Let's identify our range, which has already been done for you. We had this range high and this range low, and we have the equilibrium point. Above the equilibrium is the premium, below the equilibrium is the discount, right? So identify your internal range liquidity and your external range liquidity from the chart that's displayed above. So we had already done that. So our range high, our range low, price goes above equilibrium. That's when we start looking for what? For sales, right? So remember, this is our current market condition. Our eye looks to the left, we see an old high, we see an old high, we see a fair value gap, we see a fair value gap. So expectation is price goes to the top side and we sell so that it goes to the downside, right? So what happened now is they came to this, the last point of the market reversal occurred when they reached this fair value gap low. So when they reached this fair value gap low, we had this old 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 low, we had this fair value gap, we had this range low, right? So what they did is they came down here and they tested the fair value gap low again and dropped, and when they dropped they took out this low. Oh, check it out, it's a breaker block, it's a bearish breaker block, right? What's that? Episode 2. So a breaker block, in short, is when the market takes out an old high, it breaks out old highs, right? With this candle right here, they went to the upside and took out an old high. So when the price comes down, and we are going to look back at the same candle, the last down candle that was used before the market went to the upside, we are going to look at it and we would want them to retest it, and we look for shorts there. So we sell it here to the downside. So I'm going to show you a trade idea of how we would trade this breaker block here. Now let's start trading Crash 500. Trade 1. Immediately they go above the equilibrium, we look at the fair value gap, we sell the fair value gap here, and we exit as soon as they reach this bullish order block here, right? Remember, we exit as soon as price reaches a bullish order block or as soon as it fills this fair value gap. So they did that. That's trade number 1. Trade number 2, right? We entered this trade here, same execution, but this time around we want them to take out this old low. So that means that they came while we're still in the trade and they retested while we're still holding the trade, and they went down, they gave us profits, they took away the profits, we went into losses, and they went down. This is what we meant in the beginning of the session when we said being able to execute a trade and not worry if it plays out or not is a big flex. That's what we meant. Being able to withstand when price comes back up and you get into losses, and not worry if it's going to take you out or not, because think about it. You didn't worry and you didn't close. You were never scared, but you held your trade, right? So when you did that, it returned back in your favor and it hit your target. So that's trade number 2. Now let's look at trade 3. Trade 3 is still the same execution from here, but this time around it's not this old low, but we want them to fill this fair value gap. So immediately they reach to the top of the fair value gap, we close, because 1, the top of the fair value gap, if you look at this candle here, the midpoint of the fair value gap is the top of the order block, of the bullish order block. So that's where we exit. I hope that makes sense. Another trade, still the same execution here, but this time around we want them to take out the range low. So what that means is this trade now becomes the what? External range liquidity trade. So we traded to take out the range low. And trade number, some figure, we had this fair value gap here. So as soon as they reach the fair value gap low, we execute our trade, but it's gonna be a quick scalp. We are going to hold until they take out this low and they reach this bullish order block here, right? So as soon as they do that, that's our exit, right? Next trade, same execution, different exit. We exit as soon as they head for these lows, the low of this bullish order block, right? Another trade, we want them to take out this old low, that's where we exit. Same execution, right? Another trade, we entering on the fair value gap low above equilibrium. We go down to fill the fair value gap, right? Let's look at another trade. Same execution, same risk. Risk is above the range high, right? We want the trade to go below the equilibrium, and guess what? Not just below the equilibrium, but below the range low, this old low, and then we exit as soon as they take out the old low, or as soon as they take out the external range liquidity. Another trade, hey, it's a bunch of trades, yo, it's a lot. We have this short scalp. So what price did is they came to this fair value gap and they reacted to the fair value gap low, and they went down. They reacted to this bullish order block. As soon as they retrace to this fair value gap low, we look for shorts. We look for sells here, right? So when we look for a sell, it's a quick sell. We want them to take out this bullish order block low. So they did that and retested. Okay, that's none of our concern. We are out of the trade. Same execution, same risk, different exit. As soon as they hit this old low, that's when we exit. Next trade. Same execution, different exit, this old low. Next trade. Same execution, same risk, different exit. As soon as they fill the fair value gap, then we out. Next trade. Same execution, we are aiming for the range low or the discount old low. So we are going to take out the old low from this execution. That's enough to make money from the marketplace. So with that said, concludes our finding entries and exits from the marketplace. Now I want you to look back at the 2 previous episodes and tell me from on the comment or on the chat box if this is something you would make money from, or if this is a model that you think that you can milk the boom and crash markets, or if you are knowledgeable enough to look for such. So this is a real talk. Trading is difficult yet simple. it takes time, it takes courage and perseverance and persistence. And especially when it comes to price action, you do not rely on any indicator to tell you buy, sell, divergence, right? You are your own indicator, you are your own buy, sell, and price action requires you to study, backtest, review, research, identify repeating patterns in the market. And yes, you will blow accounts, but do not despair. Look for ways to increase your knowledge and remain and forever remain a student to the market, right? I never stop learning. I keep researching. I keep looking for what I could use for my trading. What can I add to my trading guide? And remember this, if you choose this path, give it your all, because it's a career on its own and there's more to BCC, Boom and Crash Capitalizer. It's just that we decided to hold back certain concepts because of time and complexity. So that means that we have more series coming through. But if you're looking for a new trading home, Capital Trading is ready to take you in, right? Now that's some real talk right there. But let's see what our major announcement is. So yeah, our next video, oh, that was cool, right? Our next video, we tend to $40 to $200 live. So we will share the entire trading history and a snapshot of why each trade was executed using Boom and Crash Capitalizer. So get ready. We will announce. Just make sure you are on the Telegram channel and you are up to date. We will announce when the video is dropping. It will be dropping on YouTube. It won't be a live video since we have to cut and edit from the previous history of our trades. So with that, ladies and gentlemen,